Well, let's say I'm an entrepreneur. I make plenty money, but I haven't been filing my taxes correctly. Do I have any options to invest in real estate then?
Yeah, absolutely. We can do a DSCR loan. You just need the 20% down. We don't look at income. We don't look at tax returns. We don't look at your debt. You could have so much debt, they don't care.
Tap in, Money Talk Mondays. Let's go. Money Talk Mondays. It's your host, D Saul, with another episode of the Money Talk Mondays podcast, where we talk about all things money. We talk about real estate. We talk about credit building. We talk about stocks. We talk about all things when it comes to making money. And where I grew up at, there wasn't really much conversation in our households about real estate, especially not investing. All we knew was you had a place to stay in, you lived there, and then and that's pretty much it. We didn't have any idea about building equity. We didn't have any idea about buying properties to create wealth. And today I got someone on the show that's going to teach y'all how to invest real estate, right? Show you some of the most popular methods that we use for real estate, some of the ways that you can get into real estate today, right? You can use your home, or you can go and get some of these creative financing ways that Steven is going to talk about today. Without further ado, my man, what's going on, bro?
What's up? How y'all doing today?
I'm glad you're here. Glad you're able to join. Finally, we've been talking about this a minute.
Yep.
Welcome to the Money Talk Mondays podcast, bro.
Absolutely, man. Happy to be here.
Soon as Steven got into business, he reached out to me on Facebook, wasn't it?
Yeah. Facebook might actually have been Instagram. I think 4-5 years ago.
Yep.
And it's been just communication ever since. And I'm excited to actually get on a podcast and kind of talk about some stuff with you.
Oh, yeah, man. I can appreciate your post a lot, man. I know when I first saw you, I saw how hungry you was, how you was just eager to just get in the game. And most recently, you've been having a lot of posts about DSCR loans, bank statement loans. I'm like, yeah, man, I got to get him on the podcast. We got to talk about this because a lot of my people really want to know how they can utilize all of these different products out here to start investing in real estate. This episode was brought to you guys by Credit Repair Hacks. Credit Repair Hacks is one of the world's first AI digital credit repair softwares. You're able to repair your credit directly from your phone. The system will detect any account that's negative, write a full dispute letter based on the items that's on your credit report, all from your phone. If you use my link, guys, you can get this for $29 a month. I'll leave that in the show description. Man, I want to kind of dive into some of the most popular things to do when it comes to investing, like methods that you can take, things that people throw out. They throw those terms out there: fix and flip, buy and hold, all of these different terms. So I want to talk about that. One of the most popular things I hear people saying are things like fix and flip, house hacking, the BRRRR method. So let's talk a little bit about that for my new investors out there who want to know what these different terms mean. Fix and flip, it's kind of what it's saying, right? You're going to find a property, preferably low value, right? Get it undervalued. Put the work in, fix it, and then you flip it for a profit. So you're going to put the work, you're going to renovate the house, and then you're going to sell it for the aftermarket value or the after repair value and collect the profit. In your experience, when you think about investing, right, you got the term fix and flip or buy and hold. So let's talk about buy and hold. Can you explain to my audience what buy and hold means?
Yeah, absolutely. So whether or not you are purchasing that home at first as a primary residence or an investment, you're purchasing that property, you are sometimes going to fix it up, renovate it, and then you're going to rent it out. So you're going to buy these properties, hold on to them, and rent them out.
Yeah. So in a general sense, the two things that you would do in real estate are pretty much you're either fixing and flipping. So that encompasses you getting a lump sum payment at the end of the deal, or you buying and holding it, in which you're buying and you're not selling it right off. Hold just means you're going to keep the property, right? Whether you're waiting on equity or you're just going to rent it out and get some cash flow coming in. That's actually my favorite part. What about you? You prefer fix and flip or?
It totally depends on the property. If you got a property that you're saying you can get, at a low value, needs to be renovated, you could fix it up and make a good return on it, might be worth it.
Yeah.
But also you could flip it, like we said, fix, renovate, refinance, pull your equity out and hold on to it.
Yeah.
Rent it out. So couple different. I think I'd personally want to rent. I want to build an empire of rental properties.
Yeah, so the fix and flips are good. The strategies that I give for the first time investors is, hey, if you want just a bunch of capital at first, right? Do a fix and flip first, right? Do something you're comfortable. You got cash already because you're gonna need cash or a hard money lender. We're gonna talk about that in a second, but you're gonna need cash up front for these fix and flips because you're not gonna get a mortgage on a property that has several issues that need ton of repairs. It's going to be difficult getting a mortgage that way. So a lot of times you're going to need cash, or you're going to be either paying 20% down, is that right, for a conventional loan,
Yep.
if you want that. So fix and flip is cool to get that lump sum, right? But the name of the game is creating generational wealth. Buy a property and you can eat twice, right, doing the buy and hold, right? Because you're getting a property, right? You're going to get rent and cash flow coming in. It's going to pay you every month. And then real estate appreciates in value. So while you're getting that rent every month, and you can always increase your rent every year, right? It's steady building equity over time. So you can actually have this property for 15, 20 years. And after 20 years, now you can technically you fixed it, you've been getting rent from it. Now you can flip it and get the profit. Now you can sell and get the money out after you've already been getting cash flow from it for 20 years every single month. Now you sell it, and maybe it's $100,000 more now, right? You got $100,000 in equity now. So now this property that I bought for $100,000 paid me $1,000 cash flow every month for 20 years, and now I get to sell it and get $200,000 out of it in equity. So that's my favorite. I love doing buy and hold, getting a property, getting rent in it. You know, you add so many of those doors up. Now you're looking at replacing your income, replacing your job, because now you have rent and cash flow coming in when you no longer need a job. So let's talk about some of the methods that people use, like house hacking and the Burr method. Let's talk about house hacking, because that's one of the more popular things right now. And house hacking, essentially what you're doing is you're staying in the property, or you have a tenant in the other unit that's paying your mortgage. You're almost living rent free, or you living with a reduced mortgage. Talk to me about house hacking and how does that work?
For sure. So before 2024 and 2023, FHA was your only option to purchase a multi-unit home with 3.5 or minimum amount down.
Okay.
So you could purchase as long as you're living in one unit as a primary, you could rent out up to 4 units. I mean, a 4-unit property, you could rent out the other 3 for only 3.5% down. Yeah. So in that situation, it's probably covering your mortgage and actually paying you a little bit.
Yeah.
And you also have the idea of, hey, look, I can buy a single family home, live in it for a year, save up another 3.5%, 5%, purchase another home, and rent this one out. So you can continuously do that over and over again. Just save up your 5%, save up your 5%, save up your 5%, and just continuously buy a new single family home.
Yep. House hacking, y'all. I'm telling you, you're staying in this property, and getting rent out of it. Somebody's paying your mortgage while you're saving up for the next property. Okay, let's break it down. So I buy one property, FHA, I pay 3.5% down, right? Now I take that property, I go stay in it, let the tenant pay the mortgage, right? Let's say it's a duplex, it's 2 unit. I'm staying in one unit, and I have a tenant in the other unit that's paying me rent, right? That rent should cover your mortgage or get pretty close to it. So essentially, you're living rent free. You stay there for a year while you save up another 3.5 or whatever 5% down payment for your next property. Okay, you get that down payment, you get that money, you move out of that property, put another tenant in there. Now you have 2 rents for one property. You go buy another property and do it all over again, as long as you like, until you have the amount of doors that you want. This is a real thing. People are house hacking, using the FHA loan, using the new conventional 5% loan.
Yep.
Right. You're paying a small percentage down, staying in it, allowing your tenant to pay your rent while you keep investing into more and more properties. That's genius, bro.
Yep.
That's genius. Another favorite of mine is the Burr method, right? What is it? Buy, renovate, rent, refinance, repeat, right? What a brilliant way to get into real estate. The whole key of the Burr method is finding a property that you can buy below value a little bit, but below what the market is suggesting that it costs, right? So you're gonna go in this thing, right? Traditional Burr method, you're gonna buy the property, right? You're gonna put the rehab costs in, so however much it costs to repair it, get it up to speed. You're gonna put a renter in there. Now that renter is gonna be paying you rent. This is pretty much so you can get refinancing done, right? The lenders love to see that you already have a tenant in there paying rent already. Okay. So now you have your tenant in there. Your tenant is paying you rent. So you're getting a little money off that, right? Now you put the work in, you're going to go right to that bank, and that bank is going to give you a loan, a new mortgage based off the equity or the after repair value of your property. So let's just say for easy math, you bought a property for 100,000, put 50,000 in it, right? So now you've spent 150,000 on this property, but the ARV or the after repair value is 300,000, right? So you've put in 150, but now this property is worth $300,000. To refinance it, that lender is going to give you a mortgage on that property for $300,000, right? Out of that $300,000, hey, 150,000. That's going to be the cost that you put in it, and you just basically did a cash out refinance and took $150,000. That's the amount of money that you invested in it. You just got that property for free.
Yep.
Well, let's say I'm an investor, I'm an entrepreneur. I don't have my tax returns done correctly. I make plenty money, right? I make money all the time, but I don't really know or haven't been filing my taxes correctly. Can't really just show you any hard up things in terms of a consistency with my cash flow, but I got a lot of money. Do I have any options to invest in real estate then?
Yeah, absolutely. So we have two different options. So depending on your cash flow as a self-employed person, we can look at bank statements for income. So 12 to 24 months, prove that you've been self-employed with the CPA letter. Get, the calculations done and use that strictly for your income based off of bank statements. But for people whose cash flow may not be consistent over the past 12 months, and they just have a large lump of cash, maybe a settlement, maybe they got an inheritance, we can do a DSCR loan. You just need the 20% down. We don't look at income. We don't look at tax returns.
Wow.
We don't look at your debt. You could have so much debt, they don't care.
Wow.
They want 20% down. They want to make sure that the mortgage payment is covered by the projected rent. We'll get an appraisal done to make sure that the median area rent is accurate. And that's it. They want that 20% down and a 680 credit score.
Wow. And you can pretty much get funded for this real estate investment, right? Pay 20% down. They don't care about debt. They don't look at tax returns, any of that.
Nothing.
Wow. Why aren't people taking advantage of this?
I really don't know. I think right now, the interest rates make it a little bit more difficult for those properties to cash flow. So interest rates and then of course insurance around here is just ridiculous. So
let's say you haven't been on your job for a long time. You got a steady job. You want to start investing in real estate. What are some ways that you suggest? Like I know you got your FHA products, conventional, we talked about that a little earlier. If I'm a worker and I just want to get started, right? I have no idea about real estate, investing. I got a little money. My credit is good. How can I get started being an investor?
Yeah, I mean, best way, FHA, the multi-units for sure. There's no better product out there to get the most doors for the least amount of money. If you're looking to just get into a single family house, do the house hacking in a year, and you do not own a home, USDA, it's 0% down, and you can get the sellers to pay up to 6% of the purchase price in your closing costs, which will cover just about everything. So that's one of the only loan products, if you're not a veteran, that you can get into a home for no money down at all.
Yep. And the reason why he's bringing this up, y'all, I know he's saying like, but that mean I will have to stay in that home if I use an RD loan. Well, hey, here's the thing. When you buy a real estate property, period, whether that's your home that you're staying in, you are essentially becoming an investor. Because this property is building up equity. You can always move out of that property. You can save up a down payment for another home, move out of that property and start renting it out. So as long as you're buying real estate, you are being an active investor. So you can actually invest in real estate by being a homeowner. And even if you've been a homeowner for years, you can actually take out equity of your property and go buy an investment property. Let's talk about that. If you bought your house 15 years ago, after what the market did in 2020, 2021, it's a good chance you have plenty of equity in. How would someone use the equity in their homes to start investing in real estate?
Yeah, absolutely. So one thing you don't want to do right now, because rates are so high, is do a cash out refinance. That's going to take away the low interest rate you currently have and replace it with this high 6 to 7% interest rate. So we have a home equity line of credit. It's completely separate mortgage. You keep your first. This is a second mortgage that you use like a credit card. You get total funding at closing. Let's just say want to take 50 grand out, you get your 50 grand, you could then take that 50,000 and put it back into the account, or use it to pay off some debt, put it as a down payment on another house. And then as soon as that's actually paid back down, you can go and pull it again if it's within that draw period. So home equity lines of credit are great if you've got equity looking to put it into some other properties.
Right. So for the people out there that don't really understand how equity works, right? Let's say you bought your property for $100,000 15 years ago, right? And now you've got an appraisal done, and now that same property that you paid $100,000 for is now worth $300,000, right? Equity would be the difference between the two, right?
Yep.
So if you bought it for 100, now it's worth 300,000. You have $200,000 equity in that property. So what you can do with that $200,000 is things like he said. You can get a HELOC. You got high interest credit cards that you want to pay down, or if you want to take that money as a down payment to buy an investment property, you can do that.
Yep.
FHA. How could someone get the FHA loan?
Now with FHA, we do have down payment assistance programs as well. Now, if you have the 3.5% down, don't do this. Use your money, use your cash. You are going to pay for that 3.5% one way or the other. That you're going to get a higher interest rate. You're going to be paying more a month. And depending on the grant that you go with, some are forgivable and some you are repaying. So depending on which way you go, the forgivables sound great. I don't ever have to pay this back, but you have to stay in the home for X amount of years. You can't refinance if rates drop. So you're almost like locked in. So if you got 3.5%, just put it down.
Right. No, I agree. Right. And it's there for people that absolutely need it. Right. If you absolutely need it, that's what it's there for. But if you have 3.5% down, why not do that without all of the contingencies that come with these grants, come with some of these DPA programs? Now, if you need it, like I said, take it by all means. But if you don't have to, why? Right. So FHA loan is 3.5% down, right?
3.5% down. We can go down technically to a 580 with 3.5% down, and we can actually go down to a 500 credit score if you have 10%.
Yeah, I just did an episode, and I'll leave a link to that episode. But I just did an episode about that, how a lot of lenders market 580, and I've actually seen some deals or some of my clients get approved with a less than 600 credit score, but the chances of that happening are pretty much slim, right? So while a 580 gets you in the door, I always suggest for my people to get a 620 or 640 to give yourself some wiggle room.
It's also going to help with your interest rate. So what they'll do too is you'll still be able to get approved, but they don't allow your monthly payment to go over a certain percent of your monthly income. So the higher your credit score, the higher they let that percentage go.
Gotcha. Okay. And guys, you can use an FHA loan for investment properties. I think you can go up to 4 units. Is that correct?
So you have to live in the property, but it can be up to 4 units. As long as you were living in one of the units, you can use it FHA 3.5% down on a investment property that you will be living in.
Yeah. So you have to owner occupy. You can use the FHA loan, only pay 3.5% down. You have to owner occupy it though. So that means you have to stay in it, right? And you can collect rent from the other units. If you go up to 4, there's 3 other cash flows that's coming in. You can also do this with a conventional loan now, and pay 5% down. But again, you have to owner occupy. Does that have a unit amount on that one as well?
No, yeah, conventional is the same. 2 to 4 units, 5% down. Now, the perks of conventional versus FHA is conventional is a lot more lenient on the house itself. Like, it doesn't need to be as updated as FHA. FHA is way more strict on the appraisals, but conventional is more strict on your credit score and your debt to income ratio.
Right. Gotcha. So if you got properties that kind of got it's a couple of issues. Let's say this is a perfect way you would use a conventional of FHA.
Yep.
You tried to buy a property or investment property with FHA and they denied you from their appraisal.
Yep.
Right. Go back and try to get that same property with the new conventional property. Yeah, it will be 5% down instead of 3.5%, but they are a lot more lenient on the actual property, the damages and things like that. But you got to have a higher credit score. got to be in a better financial situation to get that conventional loan.
Now, this actually just started coming up. I have a client, real estate agent of mine, who's trying to purchase his first home, and he's wanting to go in, do a 203K, buy a 4-unit property, get the cost of the renovations included for only 3.5% down.
Yeah.
And I'll get the numbers in a second. We'll post those. But for 1 to 4 units, the loan amount changes. So if you go to 4 units, you can, I want to say it's like $900,000.
Mm.
So it's dependent upon the unit for
Gotcha.
FHA. So if you go up to 4 units, you can borrow way more money. You can renovate that property, get the appreciation and the equity from the renovation, and you're renting out the other 3 units.
Wow. That's the FHA 203K loan. I talked about it on my episode a couple of weeks ago. You pay the same 3.5% down, and you can get the renovation costs included with your loan, man. That's a phenomenal way to start investing in real estate.
It's crazy.
A couple of other ways. We talked about DSCR earlier. Is that a difference from the bank statement loans that people can take?
Yeah, so the difference between the DSCR and bank statements is DSCR's no income at all. They're just wanting the down payment. It has to be an investment property, non-owner occupied.
Okay.
Bank statements can be used for either. We can use it to purchase investment properties or primary residence. And for these, we just have to prove you've been self-employed for 2 years. We actually now have a product that just needs 1 year of self-employment, but it is 25% down. So it can get done.
Cool.
With just 1 year of self-employment, which is a big thing because, you have a guy who's, let's just say, working at the plants in New Orleans for his whole life. And then he's like, hey, I want to go start a welding company. Well, as soon as he starts that welding company, we got to wait. That's a time clock. Well, now with this bank statement loan, we can go and just do 1 year of bank statement loans. We don't even need to look at the tax returns. We just get the bank statements, look at the cash flow, and calculate it that way.
Wow. So is what's the credit score requirement with that one?
So if it's for a primary residence, we can go down to a 620. But like you were saying earlier, you want to at least be a 640 for these.
Okay. Down payment, is that
10%?
10%, right? So
for primary residence.
Right. Okay. So can you use the bank statement loans for investment property?
Yeah, absolutely, and that's 20%.
20% down. Okay.
Yep.
So guys, you hear it. Like if you're you got a funky financial income situation.
Yeah.
Right. Your tax returns. I know a lot of people write off everything on their taxes to avoid paying Uncle Sam, which is cool.
We don't blame you.
Which is cool. Right. You're able to use your bank statement, the money that you receive that's showing on your bank statements to purchase a new property. 620 minimum, but get around to 640, right? 10% down for primary residence. If you want investment property, 20% down. So there's plenty of options out there for anybody that want to invest in real estate. That's cool, man. I appreciate you joining today, man. When I bring people on the show, what I like to do is I always do a gratitude session just to talk about things that we're grateful for. It doesn't have to necessarily be anything big or small, just anything that you want to elaborate on. Gratitude is so important because it keeps us in the present moment. It keeps us realizing things that we already have to be grateful about, to be thankful about. So I'm big on gratitude. So I wanted to open it up with you, man. Is there anything in particular that you're grateful for today?
Oh, man. I'm not going to lie. Today, I'm actually super grateful for our relationship. This was awesome. This was a good time. And definitely I'm thankful for Arena Title and Lettuce Media for putting this place together and just giving us a really cool place to come collaborate and get some good stuff out there.
Absolutely, man. No, good. I thank you for coming on, man. Like I said, I've seen them post. I'm like, man, I really need him to come educate my people.
For sure.
I'm grateful for you, bro. I'm grateful for Arena Title over here in the North Shore, right? So if I got any sellers out there that want to sell your home, please reach out to Arena Title for their title needs. And I'm just grateful for life, man. I'm grateful for the opportunity to wake up every day and to do what I love, right? On this podcast, educating millions of people about financial literacy is what I always dreamed about, and I'm doing it right now, right? So super grateful for that. Grateful just to have breath in my body. A lot of people take that for granted, man.
For sure.
As long as you got breath in your body, I look at it as God giving you another opportunity, another chance to be great. So that's what I'm grateful for today.
That's awesome, man.
Yep. Yep. Appreciate you, man.
Absolutely. Appreciate you having me on.
Let the people know where they can find you, man. What's your handles, your websites?
Yeah. Go check me out. It's the Rapalo Mortgage Team on Facebook, and on Instagram it's Steven STEVEN _ Rapalo RAPALO.
Y'all go follow him, man. If you're interested in purchasing or thinking about real estate, I'm going to leave a link in the description of this show, a direct link to his application. So you can apply, you can reach out to him. You have any questions about anything that we talked about today, reach out to Steven. I appreciate everyone for joining this episode today. I appreciate your support. I wrote a book a couple of years ago, How I Fixed My Own Credit in 6 months. A long time ago, y'all, I had got the job that I wanted, the job that I loved, and it got taken away from me because of my credit score. Man, real crazy that they offered me the job contingent on my credit check. I had no idea what credit was or anything, and I got the job snatched away from me. So what that led me to do was learn and teach myself everything it was about credit. And that's what I did. I fixed my credit in 6 months, and I put it all in the book. So I greatly appreciate if y'all support me to get a copy of my new book, How I Fixed My Own Credit in 6 months. I talk about everything credit when it comes to credit building. And even if you want to repair your own credit, I put it all in that book. 10% of each copy sold goes directly to my efforts of teaching financial literacy in all the high schools in the world, y'all. I would definitely appreciate the support. I'm the host of the Money Talk Mondays podcast. I'm a realtor and I serve all 50 states. Like, share, and subscribe to this message. Until the next time, we out of here.
Y'all take it easy.
Peace.
Pause me.